basic concept point of view at the time of audit. The Pune branch of WIRC is organized the skill development program for 7 days. We are happy and we are definitely say that we are lucky to organize this type of skill development program for the student. Today is the 1st of July. Today is the foundation day of our CA Institute, and we are celebrating 27th, 72 birthday of our institution. And for that purpose, we wish you all of you the very happy CA day. And I will introduce today the Kusai sir, Goa Walaji, regarding the audit point of view. He is a chartered accountant. He is passed out in the year 86. Last 35 years, he is practicing chartered accountant, giving various lectures, organizing various seminars, giving various keynote addresses in various seminar, workshop, and other seminar, etc. He is well-known audit practitioner. He knows how to deal the audit techniques, how to tackle the audit problems for the various organizations, and accordingly, he will explain us today the basic concept of auditing and what are the points and what are the basic concept the auditor should know at the time of audit. Really speaking, auditor is not blood hunt. Auditor is real philosopher, guide, and in short, the eyes and ears of the management. And from that angle point of view, students should aware the auditor is not blunt hunt. We are understanding that auditor is giving various troubles, etc., exploitation. No, auditor is guide, auditor is philosopher, and accordingly, auditor is very, very well-wisher of that particular organization. And from that angle, from that point of view, this audit is very important factor of organization point of view, any company point of view, as well as any organization point of view. And for that purpose, students should learn by heart the audit techniques, audit basic concept, and what are the methods of audit, what should be the precautions taken at the time of audit, etc. Basic information will be given by Kusai sir. He is chartered accountant, and he will explain you the proper philosophy of that audit. Today is the 1st of July. Therefore, once again, I congratulate all of you, the CA Day, medical fraternity, Doctors Day, as well as the in case of Maharashtra, today is Agriculture Day also, for farmers Day also we can say. And for that purpose, this is very good occasion. And for the purpose of that, we got a good lecturer for today, the Kusai sir. I overtake to the Kusai sir and request him to deliver his speech and his ideas, his techniques, and his wisdom for the purpose of student, and motivate the student what we should do and what we should decide in the life of their time. Okay, over to Kusai sir. Thank you, sir.
Thank you, Mahadevji. Now I'll share the screen for the purpose of the members here. Okay. First of all, I would like to thank the Institute of Chartered Accountants of India, Pune branch, for giving me this opportunity of addressing the students today. Mahadevji, Kashinathji, and the other committee members of the Pune branch. First of all, I want to wish you all a very happy happy CA day today. And I want to wish all my future chartered accountants, the students who are going to be the participants of this particular seminar today, who are going to be the next generation of our chartered accountants. And we are going to take you through the process of auditing as of now. Before I go into this particular process, the auditing, let me just share with you a few important aspects. Suppose there are two papers before us, one paper, one page, which has got financial statements, and on the right hand side, the financial statements are duly signed by the managing director of the company, the executive director of the company secretary, the CFO, everybody. And the left side is blank. So the one page is with that signature. Then there is a page 2. There's another page, similar financial statements, where all these 4 people have signed on the right side. And there is also one small signature added, and that is of a chartered accountant under his name, under his banner. The value I'm not saying the value of the first page is not there, but the value of the second page has improved many, many times. Why? Because of that small signature of a chartered accountant. The reliability, the trust, and on the paper which is there on the second page, second paper has got high level of acceptability in the society is just because of that small signature of a chartered accountant. So that signature of a chartered accountant makes so much of a difference of a value to that second page. Now, it is we who have to, I mean, the entire society reposes so much of faith and, trust in the signature of the chartered accountant that the value of that page has changed. Now, on this CA day, I would want all of our students who are going to be the future chartered accountants to take a pledge, to pledge within ourselves, saying that we will maintain highest level of integrity when we become chartered accountants, so that, or even now also when you are working as a student of a chartered accountant, so that the name of this chartered accountant will be, the honor and the name of this chartered accountant will be always held in high esteem. This is our pledge. This we should always keep in mind as our culture and in our blood, that how we will deal with in our future course of action. Now let's look at what is audit. What is auditing? And first of all, when I said that there is a page 1 which is signed by the management, and then there is a page 2 apart from management, there is a signature of the chartered accountant. So what that the transformation of that first page to second page, the process which transforms that is called auditing. So we'll try and understand what is the process which we are looking at of the audit. Our today's agenda is to understand the meaning of audit, the essentials of conducting an audit, the background of auditing, because auditing standards are what makes this process very important, and applying how are going to apply those auditing standards. And if people who have heard me earlier, who have heard my lectures earlier, I have one basic methodology of explaining things. I don't believe in mugging up, and in CA course you can't mug up. You have to understand the concept, the why behind a particular aspect. If you understand the why of each and everything, you will not have to remember for life, and you will be able to understand everything correctly, and you will be able to implement it correctly. You won't there's no question of mugging up things. So we will understand the concept. It's like if you look backwards, apple must have fallen in so many people's head. It was only Newton who asked why. And that why is very important, because if you ask questions why, you will get answers, and that answers will be will give you a lot of value to what you want to do. Now let's understand the dictionary meaning of audit. What is the meaning of audit? A systematic and independent is very important, verification of records to arrive at an opinion about the financial statements, whether the same are free from misstatements. Now this wording, free from misstatements, financial statements free from misstatements, is the foundation stone of any audit. So you will come across these statements all along. I mean, this particular line all along the auditing standards, all along the audit books. This is a very common line in entire audit paraphernalia. Now, what is the meaning of this? Free from misstatement. What is a misstatement? A misstatement means error. Any financial statement can have errors. We are not saying that there cannot be any error, but this auditing process will identify those errors and will be able to then remove those errors from eliminate those errors from the financial statement. And that is how the identification process of those errors is a audit. Now we will go into the exact aspect of how do you do that, how do you find out misstatements, and what are the misstatements. It should be material misstatement. All these things we will discuss over a period of next 2 hours. So please be with me, and so that you will be able to understand the concept as to how this audit has to be done. The Latin meaning of the audit is to year. How did audit word originate? Audit word has originated from the word year, to year. That means you have to be receptive to all the ideas and news, whatever is happening in the client's or entity's environment, and hear those aspects. And in fact, sometimes we say that the financial statements speak. So you should be able to hear those financial statements. And that is our ability as an auditor, as a chartered accountant. We are trained to do that so that that financial statements start talking to us. And so we are able to hear that. The earlier, of course, the concept was that the auditor used to call the accountants to hear them. And that's how the word audit, matlab to order. Order is the Latin word, which from which this audit word has been derived. Now, what are the essentials of conducting an audit? The responsibility of financial statement. Who is responsible? We are not. As an auditor, we are not responsible for financial statement. That is very important aspect. If we ourselves are the makers of financial statement, we can't audit because we can't audit our own work. So we have to be very clear that the responsibility of financial statement always lies on the management, and it is not the auditor's responsibility to prepare financial statements, because our role starts after the financial statements are prepared, and then we start evaluating them, start analyzing them, and then applying all that audit process to find out whether there are misstatements in their audit financial statements. And that is how our role starts from there. So auditor's responsibility starts after the financial statements are made or the accounts are made, and then we start looking at how the audit should work. The most third important thing of an essential of conducting an audit is an independence. There is a full chapter on the discussion today on independence, because that is the crux of the whole thing. When I said there was one page which was signed by 4 people here on the one side, having all big people, managing director, CFO, all these people were there. On the other side, we have a chartered accountant signing it. The reliability and the acceptability of that financial statement has increased considerably because of that word independence. Because all the others were connected with the company, so their independence cannot be established. Here, the independence is established because it's an outsider. He's an independent agency which has to look at those financial statements in a totally independent and unbiased manner. Ethics. We are of course bound by our institute's ethics, and if there is any negligence on that part, we will be liable for all disciplinary action, which is very serious. So a person might lose the entire effort which he has put in to pass his CA exams, and just by a small error or small negligence on his part, he might find himself in a very difficult situation. So as I said, we all must work towards that high level of integrity and ethics so that we don't get into this situation. Professional skepticism is what we have to apply. We don't have to go by an accepted norm. Okay, everything is all right. We have to just accept it. No, we have to question each and everything. As I said, question why. Each and every aspect has to be questioned so that we get answers. And then if you're satisfied, then only we are able to frame an opinion on that. Analytical ability. Each figures have to be analyzed in various different aspects, and they will come out with various different scenarios. And those scenarios will come out with situations where the possibility of errors have been occurring. So this analytical ability is what is ingrained in our training program, in our entire CA course, so that we are always analytical of any aspects, and we always look at things in a very professional manner and analytical manner as to how the figures have moved. And if we find that there is some abnormality in the movement of the figures, we immediately will start questioning it, and we definitely will locate those errors. E-auditing. Nowadays, of course, the computer technology, the ERPs, the SAP, all these things have been very much prominent, and you don't get those traditional bookkeeping for verifying the audits. You have to work around the computer. You have to do the audit around the computer. So you have to learn the new skills and technology as to how we are going to do audit in an e-environment, and able to do a computer-based audit. So all these techniques we all have to learn, and we are already learning in a part of our course. And this is the need of the hour. Now, of course, with all this last 4 months of work from home, we also have learned a lot of new techniques. Today we are doing this seminar on a video basis. Otherwise, it would have been in an auditorium. So all these techniques we have to undergo. We have to change with times and see the situation, and we have to learn new techniques. When I passed my CA in 1986. The computer was a new emergence, and initially we used to audit on the manual accounts, so it was a totally different ball game. Now, of course, with computers, there has been a lot of change in our approach to the audit. Now let's look at standards on auditing. Now, what is standards on auditing? See, what has happened is institute has prescribed Okay, if you are able to perform your audit based on the standards of auditing, your professional work is established. Then, see, generally the standards are so well designed by the institute that it will always have a very high probability of throwing up errors. If you follow the standards by the proper in substance, and if you do that, we will go through all those standards and we'll see how it will throw up, as I said, why how it will throw up this particular this errors. It will definitely be able to bring out various issues in the financial statements. And if you do it, of course, in substance, and your audit will be complete, and you will then be able to withstand any problems later on. Anybody is raising any claim, you will be able to say, yes, I have performed the audit as per the standards of auditing, and there is no question of any negligence on my part. So this is what we have to follow. It will prove the quality assurance that yes, a quality of a level of audit which is expected by the society from us is being given. It covers all aspects required to make an assertion, because we have to make an assertion in our audit view, whether the financial statements are true and fair. We have to make an assertion, and to make that assertion, you need to cover all aspects required to make that assertion. What can go wrong? This is a very important technique which we are using in our office. How does it help? For anything that we want to do audit, we have to first ask this question: in this particular scenario, what can go wrong? So then you list out various scenarios, what can go wrong in this particular scenarios, and try to cover up in your audit program. Like, for example, if you are auditing sales, what can go wrong in sales? Some sales can, you already sold material, but you have not recorded the sales. Some material is sold on the approval basis, material has been dispatched, services are rendered, not recorded. It is possible in a service organization. It is more prominent because it is very difficult to identify when the services were rendered. So all that, what can go wrong, will give you an idea as to, in this particular scenario, in this particular situation, what are the aspects which can go wrong and can lead to misstatements. And if those aspects, if you are able to cover in your audit program, then your audit will be more meaningful. It will be able to bring out some errors in the program. Support in terms of subsequent claims. If you have a proper auditing standards followed, then you are in a position to substantiate any claims later on. Professional diligence is established that yes, I have been very diligent, I have not been negligent, and that will save you if it is any issue later on. Now, the certain standards we will discuss from 700 onwards have been modified in line with international standards to meet with those international global standards. India is moving towards globalization. Our Indian accounting standards have gone into IFRS. So we have progressed towards the globalization. So our auditing standards now are in line with international accounting standards, and our reporting formats are also being tuned in line with international standards. So what was earlier only Indian, now it is global, because when a company in UK or investor in UK is reading our report, he should feel at home, because he should feel that what is being given a report globally should be our format of report. It should not be a different. And that is the reason, again, why. Again, I will explain you when we go to that particular section, to why this report was modified and what is the advantages we have received from this modification. Now, which are the different kinds of standards of auditing? Which are the processes assessing a risk? Now, what is the risk? We'll come to it. What is the risk? Because there is a risk. Risk, not the risk of auditing, but risk involved in the financial statements, and that we will identify where we have to identify the risk. Planning an audit around that risk, because once you identify the risk, then you can plan your audit. Without identifying the risk, how will you plan the audit? Documentation. This is the most key important aspect of your entire audit process. I will come to it as to why do we need documentation so well. Audit evidence, because that is what we have to verify. Sampling techniques, because we don't do 100% verification, we only take up a sample. Now, how that sample has been taken is also is important. Okay. External confirmation. These are all methodology of doing the audit process. Analytical review, I mentioned to you, we are always analytical of things, and we will have to do analytical review. Estimate uncertainties. In our financial statements, there are so many items, if you see, are all estimates. Depreciation is an estimate. If you look at AS7, your AS7 working is totally based on estimates. There are so many provisions that are in estimate. Gratuity provision is estimate. So we are verifying, we are auditing a lot of. In fact, in one of my lectures I had earlier mentioned that when we say that it is a statement of profit and loss account, I should say we should say statement of estimated profit and loss account, because most of the items in the P&L account are estimates. So I mean, whether are we having actuals or we are having estimates is a question. But yes, there are very scientific method of determining those estimates. And if that is done in that scientific method, the estimates will be right. It is not something like a guesstimate. I'm not saying it is a guesstimate, it is an estimate. So it has to be scientifically done. Fraud. Although, as Mahadev sir said, we are not bloodhound. We are not starting our audit with an intention saying that there is a fraud in the company. No, we are not going with that mindset that we are only going to locate the fraud. No, that is not our objective as an auditor. Yes, as a part of the audit process, if we are able to detect fraud, fine. That is one of the aspects here. But that is not the ultimate objective. That is not the starting point of the audit. Our audit point is to find out any material misstatement, as we have mentioned in the auditing. That is what we have to see. That we have to find out the material misstatement. No, material misstatement could be anything. It could be error. It could be fraud. Anything. So our objective is to find out and to identify material misstatement. If it is there, eliminate. Going concern. It is a fundamental principle that the accounts are made as per going concern. Today, in today's situation when COVID is there and where there is been a lockdown for so many months, there has been a heavy impact on the economy. Going concern is going to be a very important challenge for March 20, where many companies will have situations where they might have liquidity constraints, will have issues, losses, net worth issues, all these things. So this time, March 20 and March 21 audit, we will have to be very careful in terms of examining going concern concept, because it is quite possible that you have just signed off a balance sheet saying it is a going concern. After a few months, the company is going for bankruptcy. So you will be in big trouble. So you have to examine the aspects very carefully about the going concern, whether the company has, what is the going concern? A company has enough resources to meet its liabilities on a normal basis, not by an abnormal basis, normal basis. Relying on work of an expert, it is very important, because every time you are not expert in all areas. You have to rely on some other expert, like for example, a civil architect or civil engineer for some other aspects. You are not supposed to know what is the cement, steel usage in a construction industry. You have to rely on an expert. So you have to rely. How do you rely on a work of an expert? Again, there is a standard for that. You cannot just accept any certificate and say, okay, fine, I'm relying on an expert. No, that cannot. There is a process. Reporting and conclusion. Ultimately, when you do all this audit, you will come to certain opinion. And how do you report? Our auditor cannot, I'm again repeat, we are not the authors of financial statements. We are not. Who is the author? The author is the company. The responsibility, the management, the responsibility of the financial statement lies with the management. So they are the people who are making the financial statement. We only have a right of reporting. That is our audit report. Now, yes, while we are discussing with the management, when we have identified some misstatements and we are able to point out to them, if the management accepts our contention and they rectify those financial statements, then there is no need to put it in our report, because it is already rectified. The financial statements are then free from misstatements. But suppose if the management has another view, so no, we do not agree with your view, and they still continue with those misstatements in financial statement. What is our aim? We can't put a gun on the head and say, no, you have to rectify. No, we can't. We don't have the powers. We don't have the authority. Our authority is only the report. The financial statement, the ultimate, the key is in the hands of the management. So if they accept our contention, fine. If they don't, then we only have one solution, and that is to put in our report and let the shareholders decide what they want to do. Shareholders will be informed that these are the areas on which we do not agree with the management, and that has been brought out in the report. So our key is the report and not the financial statement. We only endorse financial statement to make it relatable to the report, which report we have signed, and there is a financial statement attached to it to identify those financial statement on which we are reporting. I'll share with you a very interesting thing. In India, of course, in most of the countries, we have this principle of the report and the balance sheet financial statements are signed by the auditor. We are also interacting with a client in Thailand, and there the audit is done by some local CPA. there the process is totally different. The report is signed by the auditor. The financial statements are never signed by the auditor. So I asked them, okay, you have signed this report and there is a financial statement attached to it. How do you know that this financial statement is the one which you are referring in your report? There is no identification. There is no one-to-one identification. So, I mean, your report is there and somebody may can attach some another financial statements. How do you know? So this is something anyway, it is there in their country. We can't change that law. But in India, that the basically thing is that identifying which financial statements we are reporting on. So that's the reason we are signing those financial. We are not taking responsibility for the financial statement. We are only identifying that along with, because it says as per our report of event date. So it is to be right in line with the report of event date. If the report is clean, the financial statements are clean. If it is not, then the financial statement has to be read in conjunction with the report. Now we go to the first aspect of our audit process, which says identifying and assessing the risks of material misstatement. SA 315. Now, first, of course, before you start the audit, at least you should be able to identify what is that in this particular. See, each entity will have a different risks of material misstatement. You cannot generalize for all the entities because each one will have a different operating levels, operating standards. I mean, they have a different industry thing, and each industry, each method of operations, everywhere, each company will have its own elements of risk in terms of misstatements. So we have to look at each item, each company entity separately. We can't generalize. Okay, but we have to follow a process to identifying this particular risk. Now, SA 315. Now, this is the standard which deals with how do you identify and assess a risk of material misstatement. Now, it says that there are, first of all, you have to understand the entity and its environment. So before you take up any audit assignment, you should first understand the entity. What is the background of the entity? What business they are in? What is the type of management they have? What is the organizational structure? Whether they have a professional management or is it some family business? All this will determine the risk factor. Suppose if it is a highly family-owned business, the risk factor might be slightly higher because their possibility of control risk will be little low, because the family-owned business, the managing director or the owner will be like, oh, it's my company, so he can think that it is like proprietary concern for him. So he may be operating the company like a proprietary concern. But there are companies, you have to follow the rules, you have to follow the norms. But this is possible. So in that situation, control risk might be a little bit of a problem. But in case of a professional management, which like company like Infosys and all, where there is a high level of professionalism, there is a full structure, and there are certain standard operating processes and all that, the control risks may be on a lower side. But there might be other risks which we have to identify. That is another thing. But each entity will have a different risk factor. Now let's look at, of course, internal control. What kind of internal control systems have been set up in a family-owned companies? Generally, you don't find those kind of high level of internal controls. You will have more of internal management type of thing where there are no control systems. Proper documented control system. There might be some informal systems working, but not a proper documented internal control. So all that will increases the risk of misstatement. So see, what I am trying to say is, depending on the type of organization, depending on the type of the environment, depending type of entity, the risk factors may either increase or reduce. Now, what is the risk? What type of risks I am talking about? Risks of material misstatement going into the financial statement. That means a financial statement which is given by the management may have a high number of material misstatement. That is a high risk. If low risk means there is a very low chance of a material misstatement getting into a financial statement. So that is very simple. Now, what kind of risks are we looking at? Inherent risk, control risk, and detection risk. Now, I'll give you some examples to identify. See, these are all very technical terms, and I will explain you each technical term as to how, in practical situation, we are going to implement. Inherent risk. I will give you a simple example. Suppose when you start an audit, and there is a company which has got two different kinds of stream of revenue. One stream of revenue is rent, okay, and there is another stream of revenue which has got a construction contract, okay, A7, A7 accounting standard 7 construction contract. Now, when you are auditing these two stream of revenue, in which stream of revenue would you find a higher risk of material misstatement compared to the other? Today we can't interact because of this video thing, so I will answer this question. In case of rent, the inherent risk of material misstatement will be low. Why low? Because very simple, no, it is to find out rent. It is very simple. You have to go through the agreement, see what is the rent given, multiply by number of months the particular that premises has been occupied. It's easy to work it out. So the risk factor of an error creeping into a financial statement on account of rent will be much lower compared to now your AS7. Now look at AS7. Very simple. AS7, how do you work it out? You have a sales revenue which is estimated. You have a cost which is estimated. Now you work out what is the percentage of your contribution, your gross profit based on the sales and the estimated cost. Let's say it's 20%. Now you work out, you have got some cost which is already incurred by the company, actual cost incurred. Now you are going to relate to the estimated cost and work out your percentage completion. And after you work out that percentage completion, you will recognize the revenue, and then you will recognize the cost, and you will recognize the profit. Now just imagine, in this situation, the risk factor is very high. The inherent risk of that particular element of revenue is very high. Why? Because tomorrow, if that cost estimate of the contract is wrongly estimated. Suppose, I'll give you an example. Suppose if 1,000 rupees is the contract value, sales value, they have estimated 800 rupees as the construction cost. So your 200 rupees is your profit. That is what they've estimated. Now you have incurred 400 rupees as your actual cost. So your percentage completion is 50%. So you are going to recognize 500 rupees sales, 400 rupees is your cost, and 100 rupees is a profit because 50% complete. So this is what you would have done it. Now it's all based on what? On the estimated cost of 800 rupees. Suppose if this 800 becomes 900 or it becomes 700. Suppose if the management would have put that figure as 900 or 700, your entire sales, cost, profit, everything changes. So the chances of material misstatement is all depending on that estimate figure, which is not in your control. Now, see, as a chartered accountant, you are not trained to work out or to find out whether the cost of that cement, steel, what is required for construction is how much. You are not. Are you a civil engineer? No, you are a chartered accountant. So how do you do it? Now, this is the inherent risk, which is a higher risk. So you have to mitigate this risk, because you are going to sign off the financial statement. You are going to say that this financial statements are free from misstatements. How are you going to do it? You do not know what is cement, what is a steel, how much you're going to, and you're going to say, everything is fine. How can you say that? So what you will do is, you will vet this estimate cost very carefully. So your audit program, you identify the risk now. Your risk is basically your cost estimation. Okay. So when you say it's a cost estimation, now you are going to work towards, eliminating any misstatement in this cost. So what you do is, you identify a particular professional who is a civil engineer or is a very senior man who is able to say honestly and unbiasedly what is the cost of to be incurred for this particular, doing this work. If he vets this particular estimate of the management and says, yes, it is 800 is correct, then your risk is mitigated. And now you can rely, now again, relying on that work of an expert, as I told you. So whether he's reliable, that first you have to see. You can't just give it to any Tom, Dick, and Harry. You have to see whether he is expert in that field. He's got an ability to give you the certificate. Okay. So you have to see what is his level of operation, whether he's biased, whether he's unbiased, whether he's a part of the management, whether he's independence. All this we have to see. And then only you rely on that. There are again the standards. We will come to that a little later. How do you rely on a work of an independent expert? So that is how you mitigate your inherent risk. So you identify the risk now. Now you have to work towards in your audit program to mitigate that particular risk. Control risk, as I mentioned to you, in a family-owned organization, possibility of control risk is very high. So you have to now work towards, you cannot then do a sampling. You have to do a substantive audit. Now you have to also look at how you are going to find out any abnormal transactions like this where control override is there. I'll give you a simple example. In a small entity where there is a family-owned organization, where there is a managing director who is the ultimately the owner of the entity, he will call up the CFO and says, please make out a check of 10 lakh rupees. The CFO will get up. He'll forget all his internal control process. He should require a PO. He will require all this process to issue this check. All that is required. But he will forget all this because he is direct instructions from his boss. And when that happens, the control is over. So in that situation, you will have to focus more on those internal control checks and internal control balances, plus the kind of possible chance of control overrides. So if you have situations where there is a possibility of abnormal transactions, control overrides, you will have to look for those transactions and identify your risk and minimize those risks. Detection risk is a sampling risk. Generally, when there are huge volume of transaction, it is not expected that you are going to do 100% verification. It's not even expected. You can do a sampling. You have to do a sampling and detect out of that sample. You have to detect some errors, and then that applies to the whole scenario. And there are, of course, there are rules. We will come to that a little later when we go into sampling as to how you are going to identify the sample and detect, the risk, and how do you minimize the risks. All that is there as a part of my sampling slide. So this sampling is again a very interesting point. How do you detect? Now there are some transactions which you will miss out in spite of all your auditing process. You will miss out some transaction because it is so well designed, so carefully done that it will escape your attention. Now I'll give you a simple one example. I will give you of a real life situation. We were auditing. We were asked by one company which is already had implemented a project for a road project, and then they told us, okay, look, we find that something is wrong and the cost is very high compared to what was anticipated, and we are not able to detect whether it is a fraud or something like that. You please help us. So we went into the verification, and when we checked all the purchase bills, we found everything in order. Everything, there was a purchase order, there was a proper quotations, all the everything. The process was perfectly followed, and there was nothing which could come to light from verification of those bills. Like the bills were perfect. When we verified with the party suppliers, they said yes, it has been supplied. There is all the transport receipts, everything was there. All the approvals, authority check payments, everything was perfect. TDS was deducted, everything was perfect. Now, how do you detect? But we still felt, but we internally we knew that there is something fishy about it, and it was not correct. So we said, okay, do one thing. Again, I said, let us involve an expert in this field. We asked one civil engineer to say that, okay, look, if I have to do this work, I do not know how much cement, steel, and all is required to make this thing. Please tell us, based on this design, what is the standard consumption of any of this product, any of these materials? Tell us. So he said, okay, fine. He worked it out. Then we added certain, 5-10% of wastages and inefficiencies, all that, because you have to give some weightage to the practical aspects. But you can't apply theory straight in practice. There are certain practical issues like 5% wastage. Hone wala hai. So okay, that we gave some factors of that. And after that also we found that there's a big gap between the actuals and those standards. And then we could find out, yes, there is certain override of this thing, and we could detect a major fraud in that. So this is how the risks we have to identify. Yes, there is a possibility of some control override, something which has been very nicely done, so that you cannot detect. As I said, you don't start the work with a fraud, but then your processes should be such that you should be able to detect this kind of situations. Now, the objective is to provide a basis for designing and implementing response to the assess risk. That is how the audit, you will have to design your entire planning based on that. You have to find out how you are going to find out this material misstatement. Again, I'm saying material misstatement. What is material? Material means it is all related to each entity. You can't generalize. Generally, for our organization, we have kept a material benchmarking of 5%. Some companies or some entities also do it at 10%. It is up to between 5 to 10% is a good material benchmark. If anything beyond, it is considered as material. Now, for example, if naturally in any financial statement there is so many misstatements, but you are not interested in small items. Like for example, if a company which has got 1,000 crore turnover, 100 crore profit, even an error of 1 crore is not material, because it is less than 1% in terms of profit and 0.1% in terms of turnover. So it is not going to be materially, making any difference to the financial statement. But yes, if the company's turnover is around 50 crores or something, 1 crore is definitely material. So definitely you have to look at it from the perspective of each entity's turnover and materiality concept. And based on that, you have to identify whether a statement is material or not material. You have to reduce the risks of material misstatement to an acceptably low level, because if it is at a high level, then then your opinion will differ. And once the opinion differs, then how you are going to report in your audit, we'll look at it in the last part. So there are about almost 80 to 90 slides, but I don't think we will have sufficient time to run through each and every slide. So what I may skip something which is not very important, but I will focus more on the critical slides. And if the institute permits, or if they wish, they can circulate this to the student. I have no objection on that. So how do you apply this process? As I said, you have to understand the entity and environment, its control systems, and certain risks require special audit consideration, like how we did a special audit. We had some consultant doing some special work for us. So all that thing we have to apply mind, because that is what we have been trained for, analytical mind, and then we identify how do you plug this particular issue. Now, documentation again is very important. For each and every aspect, there has to be a documentation. I will come to the section of documentation, how important a documentation is. There are many complex structures people design to bring about some maneuvers and or manipulations in the financial statement. You have to see through those structures and see why these structures have been designed, what is the purpose of these structures. And if there are, there was some very famous case of some company where there was a huge amount of some structures were laid down, and because of that structures some fraud was perpetrated. So we have to see through those structures. We have to open up those structures and see what is the objective behind this, to have these structures, and whether there is anything used for the structures to do some manipulation. Now, how to do this objective, how to achieve this objective is to make inquiries with the management. You have to keep talking. As I said, audit is to hear. You have to hear the management and see what is there. You would ask proper questions. Question is to be very well drafted, and that questions will give a lot of answers from the management, and those answers will give you a lot of inputs about your audit. And the audits answers are so structured, the questions are so structured that there is no there are cross and check balances. Like how you have an IQ test, there are always cross and check balances. The questions should be so structured that management cannot lie to you, or because if they try to lie you in one question, probably in the second, third question, they may get caught. So your structure should be very, very well defined and well designed. Again, I'm mentioning analytical procedure, which is very important. Observation and inspection. Whenever you are doing an audit, you should keep your eyes and nose open, because you should be able to see how things are happening in the organization, and that will give you a lot of ideas about how the organization is functioning. Information obtained in the prior periods. If you have already done the audit in the earlier period, if they have found some very major issues, that will be the basis for your current, or also not that it is the only basis, but at least to start with, this is a basis. Okay, at least we have found something, at least that has to be taken care. Discussion among the engagement team, because there are some people doing some other work, somebody is doing purchase, somebody is doing something else. So all they have to sit together and discuss, because there might be some interlinking of that within the team. So consideration specific to smaller entities. Now see what happens. There's a large entity, the consideration is totally different, because they will have a total professional approach. They will be having IT systems, they'll be having professional management, there will be an internal control system, all this will be there. But in a smaller entities, generally this is all taken a back seat. And so you will have to be more careful in those entities where there is lack of controls or lack of systems. So your focus should be more, more on that. Risks arising from IT. When you say, okay, everything is going through computer and you accept it, no, that is not correct. You should also see the processes which IT is following. There was a major fraud in one bank. I will not name that bank, in one foreign country. What had happened is the person who was operating it had an access to the programming or with a collusion with a programmer of the software of that particular the ERP which was installed in the bank. What he had done in collusion with that programmer is that he had designed a small bug in the program, that any rounding up difference, there are some rounding up differences, 2 cents or 5 cents or whatever, that was getting credited to a special account. And that special account, he knew he had a password, he was able to withdraw huge, millions and millions of dollars out of the bank, and he absconded. So this is possible. You can't just accept IT as, okay, IT is everything is perfect. No. Go through the processes, see how the IT is coming out with results. If you find any bugs, you must point out. So this IT system audit also is an important part of your audit. Of course, it is not to be done every year. It has to be done at least when you start the audit, or after maybe a few years down the line when you can have a review of the auditing of the IT systems. Internal audit function. Suppose if the company, you are a statutory auditor, if there is an internal auditor, then you look at how the internal audit is being positioned, what is this, what is the independence, what is the level of the internal audit firm. Then what you also have to look at what scope has been defined so that you can eliminate duplication. Okay, whatever internal auditor is doing, you need not do it. You can rely, depending on whether you can rely on that internal auditor. If it is a firm of chartered accountant, then reliance is much higher because an internal audit is done by a professional. So this kind of things you will have to evaluate and see whether an expert or a professional is working on it. So your area of work, you can remove that from your, and you can focus on something else and distribute the areas between two of you and work very in a much better way. Related party transactions. These are the transactions which may have misstatements, which can, not necessarily every time related party will have always an error, but it is a good breeding ground for errors. So because when there is a related party transaction, there is a possibility that because of the familiarity, there is a possibility of a collusion, and there is a possibility of the amount of the transactions being not correctly reported. For example, if you're doing a sale to a related party, it could be either inflated or deflated depending on the need of the requirement, or even the purchases can be either inflated or deflated. So that is possibility is there, but that is not always to be assumed. But you have to look at those transactions more in detail with a little bit of a microscope and see whether you find such kind of situations in that case. Control environment, integrity and ethical values. This is very important. How the management is ethical, how management's integrity, all that will play an important role in identifying material misstatements. If the ethical values are very high, then you can also rely on trust the management. Yes, there will not be any manipulation. There might be some errors. That could be unintentional error, but there may not be intentional errors. Commitment to competence. Yes, whether the environment wants to do correct, want to do perfect. Participating, how much they are participating in your audit process, how much they are supporting you. All that also will determine the audit control environment. Management's philosophy and operating style, how they are operating. If they are operating in a haphazard manner, then your audit should be more in depth. You should be having more systems control. Organization structure, how it is designed. If it is very professional, there are so many professionals in the system. There are many chartered accountants in the finance department, accounts department. Then your reliance also on that goes up drastically. Okay, they will perform their work professionally. All this is very important. Assignment of authority and responsibility, how they have assigned the authority and responsibility to various people. That also will determine in your audit program. Human resource policies and practices. Whether there is a huge amount of turnover in the accounting functions, then also will determine whether there is any issues or problems. That also will give you an idea to design your audit program. Performance reviews, how the management is doing their performance, information processing, physical controls, segregation of duties. All this will indicate your audit program. Now, based on whatever you have learned in that assessing risk, you have to plan an audit. So that is again ASA 300 to 330, which will design you to plan. Now you have to design based on what you have learned in your three risk assessments. Now you have to start planning your audit, because once you have identified the risks, now you have to mitigate. How to mitigate those risks? You have to identify the program to identify those the material misstatement in those risk areas. More focus on the higher risk areas, less focus on the lower risk areas, and then audit program should be accordingly designed. So we should obtain sufficient, appropriate, very important, sufficient, appropriate audit evidence to, to assess, then you check whether the risks what you have assessed, whether it is really risks or it is perfectly taken, or it is financial statements are free from misstatement. That is again our ultimate objective. But now test of controls, you check control systems. You do a test check of control system, whether the controls are operating. So that is one thing which you will do. First you will initially see the system, whether the whatever the management and set up a control system, whether that is operating. If it is operating fine, then your reliances on the sampling will be higher. If it is not operating fine, then you might do a more substantive audit rather than doing a sampling audit. Because if the control systems are good and it is perfectly functioning, then you can do a lesser number of sample, but do a more in-depth audit. So that all will depend on what is the level of control systems in the audit. Substantive procedures, only when you find that internal controls are not very good, you might have to do substantive. You might have to do 100% audit. You might have to do more of checking, more of verification. So in that situation, you will do. Of course, you will do more of substantive processing in the closing process. The financial last closing entries, journal entries, you would like to do it 100%. You can't just do a test check, because those are the things which will ultimately impact the financial statements materially. Timing, when are you going to do substantive process also is very important. At what point of time you are going to do the substantive process. Now, what are we going to make assertions about? We are going to make assertions about the transactions. First of all, each transaction, its occurrence, whether it has occurred, whether the transaction has occurred, whether there is a purchase or actually just a bill has been recorded. So we have to see whether the actual transaction has occurred, whether it is complete in all respects. The transaction is recorded, but whether it is complete, whether the accuracy of the transaction which is recorded, and the cutoff. Cutoff is very important. Suppose the purchase made in March has been recorded in April, so cutoff is not maintained. You have to provide it in March itself because the materials have come into in March, stock has been updated, the expenses incurred, so you have to book the purchase even in March. Although it might have been, the bill might have come in April, you have to record it in. So that is a cutoff procedure. This generally happens in service kind of purchases where there is no linkage with the material movement. So you have to be very careful that the bills are properly accounted. Classification, having recorded a transaction in the book, but it is wrongly classified. Capital is capitalized, recorded as a revenue, and revenue is classified as capital. The entire financial statement will be deviated. It will be wrong. Misstatement. It is also a mistake, although recorded, but it is wrongly classified. So again, that also we are supposed to check. Account balances at the end period. After all these transactions are recorded, the balances which are emerging out of the financial statement have to be verified and tested whether they are proper. There is a process for each and every balances, like for example, external confirmations for creditors, debtors balances, bank balances. You have to take external confirmation. How do you do it? Again, there is a process. And why it has been laid down that way? That again we will explain. Why each process has been laid down in a particular manner. There is a logic behind it. It's not just like that. Aisa karo. There is definitely a logic, and there is a reason why each process has been identified and designed. We'll go into it individually when you look at the external confirmations. Then the valuation of each balances, whether it is correct, the impairment procedures and all that. Okay. Now, this is how you audit will be the more persuasive substantive audit. Experienced staff, you have to put in experienced staff on the audit. You cannot just put any juniors and say, okay, chalo jaake kal se audit kar do. Aisa nahi. There has to be a team. There has to be a senior people who are the having experience in the audit. And of course, there could be in junior teams who will be learning. We are all students, so we'll be learning, but there has to be a proper process. Unpredictable audit. You can't make your audit predictable. If you do that, then the management will know that you have already done some audit earlier and said, okay, I'm going to verify all bills above 10 lakh rupees. What the management will try to do is, if there is some issue with the bill, they'll try to keep it below 10. 9,99,000 of audit read. So that don't make it predictable. Your audit should be always unpredictable. You should do your stock verification any point of time. You should not say, okay, मैं 31st March को stock verification करूँगा, या मैं जब audit के लिए जाऊँगा तभी मैं cash verification करूँगा. No, make it surprise visit. If a surprise element should always be there in your audit. If that is there, then you will find a lot of errors. If it is not surprise and if it is predictable, then possibility of the management override is possible. Taste of details, I told you about it. Control processes to be checked once in 3 years. As I said, IT you to check. All the control processes should be checked. Changes in IT authorization. Who is authorized to enter transactions in IT? Who is authorized to change programs in IT? All that you have to see whether there is any possibility of changing program, changing masters. Otherwise, you have done the audit and suddenly the masters have been changed, and you will not know what has happened. Now, the most important thing: documentation. Why prepare documents? It is not necessary that it should be always manual or physical. It could be also electronic in form. It is not necessary. Nowadays, nobody, keeps bulky things, but can always be stored in an electronic form, but it has to be properly done. Why documentation? As I said, why? The answer is, what is not documented is not done. You have done a thorough audit. Everything is perfect. You have done an audit which is as per the auditing standard, except documentation. You have not done. You have been little negligent in your documentation. अरे ठीक है, मेरे को सब मालूम है, मेरा सब माइंड में है, मैंने सब सुना है, मैंने सब देखा है. Everything is perfect. I have gone through each and every record, every transaction, and I know everything is perfect. And I have signed off the balance sheet. Everything is clear, unmodified report. Tomorrow there is a problem and there is a claim, and they come and ask you these questions. Show me your records. Even if you have done everything perfectly, there is a diligence, everything. But if you are not able to substantiate by any documents or files, you are in big trouble. Your certificate isn't for a toss. So because you are not in a position to substantiate how you did the audit. Now, so auditor's responsibility is to prepare documentation. It is your safety. So you have to say, you have done this audit. This is my supporting documents for how I did the audit. evidence of basis for conclusion. So I have made a conclusion, okay, financial statements are free from materials. How? What is the basis? This is the basis. All these papers, these are the entire process I have followed. I identified the risks. These are the risks I have identified. This is how I have planned my audit to mitigate that risk. This is what I did. This is how I verified. This is how I did. I came across some issues. How did I resolve those issues? Okay, this is the notes on that. I have resolved. I have taken this view. I have taken somebody's view, opinion. This is the opinion. All that thing will be part of. I did the verification. I did this. All that will be your supporting document for basis of your conclusion. And if you have come out after all these things and you have done a conclusion, and if suppose, for God forbid, your conclusion might have been wrong, you made some error in your conclusion, but you have followed a correct process, you will still not be negligent because you have done the correct process. And it is possible that one particular aspect can have a two opinion. You have taken one opinion, there is another opinion. There are so many people in this world, everybody might have a different opinion. But if you have followed a correct professional skepticism, professional approach, and if you have come out with an unbiased view and opinion, then your records will speak and say, yes, you have done. I will give you an example. We have gone through a peer review process. Any auditor who does the audit of listed company has to go through a peer review process. Now, what is a peer review process? The chartered accountant firm gets audited by institute, but there is a peer review board, and they send a peer reviewer to the CA firm. And the CA firm's records and the processes and the entire systems, including the recruitment policies and everything, has been verified. The training policies, how do I train my team? How do I, have my files maintained? Documentation is one of them. So what they do is they will go through my list of the audits which I have done, and they will, as a sampling, they will select some of the chartered accountant who has come from the peer review board, the peer reviewer. He will select some of the files. Okay, please give me these files, Mr. Gohala. And he will say, okay, I will be sitting in one cabin, nobody will disturb me. He will take those files and sit in the cabin. Now, after going through these files, whether it is hard or soft, it can be a soft file also, it is not necessary, it should be hard files. If after going through this file, if he does not have any questions, all the answers the questions which he have, he gets answers in that file, the peer review is successful. And if he finds that no, this question is not answered in the file, this question should have been asked, this question is never asked, you have never looked into this aspect, you should have looked into this aspect, there were no confirmations, there is no management representation, this is not there, this is not there, all these things are there. He will list out so many items or even one item. And if those audit documentation is lacking in that situation, your peer review fails. Now you don't get a peer review certificate, and if you don't get a peer review certificate, you can't audit a listed company. And of course, it is now it is a little more serious. The peer reviewer can now straight away refer the matter to the disciplinary action, okay, saying that look, this man has not done the work as per professional this, and you please initiate disciplinary action. So it is very serious. So your audit documentation has to be very, very perfect, and so that it should be speaking file. So when you don't have to go and explain, the file has to be given, the person has to be able to get answers from that file. It should be a speaking file. Why? Because see, today in a chartered accountant's office, there are so many article students, people work. They are all rotational. Today, 3 years after the articles, maybe a person will work somewhere else. He's not there, and the things will come out after 4 years. And if it is not there in the file, how will you go and check with him? Oh, what did you do at that time? You cannot. So you have to have your file thoroughly speaking, so that you don't depend on a person. It has to be a speaking file. Audit documentation enables the audit team to plan and perform the audit, the direct supervision of the audit work, be accountable for its work. So all this is possible to do in the audit process. So it provides evidence of audit what is performed and what documents we have achieved in that situation. And matters arising after the date of the auditor's report, it also gives you evidence. Okay, this came before the audit report, the auditor's report, and this came after the auditor's report. Audit evidence. As I said, audit evidence is to be checked by the auditor to see whether it matches with what the financial statement talks about. So what constitutes an audit evidence? It is performing an audit which will give you appropriate audit evidence, which is required for testing a particular financial transaction. Inconsistency, if there is there in the audit evidence, will cast a doubt on the reliability, if there are any inconsistency in the transactions. How to verify and accept? source of what is the source of audit evidence. Ideally, the more reliance is placed on an outside source. If it is an internally generated document, then the reliability goes down. For example, if there is a purchase, then naturally you will have a purchase invoice from an out supplier, which will enhance the value of that audit evidence. If it is an internally generated document which says, oh, I have paid 5 lakh rupees to somebody, that will not have a very high value of audit evidence compared to a third party confirmation saying that yes, I have received this money and for what they have given a bill supporting. So that will enhance the value. So if there is a third party, now of course, for example, I'll give an example. Suppose when you are buying materials, goods, now there is an e-way bill, which e-way bill is generated. So that is a third party. It's a government, it's generated by on the government portal. So that gives a more stronger audit evidence compared to other things because it is recorded on a government site and it has got a timing element. When the material has started and when material has reached, all it is already documented, recorded. So it is more higher level of audit evidence. Then obtaining audit evidence, confirmation. How do you get confirmation? Is again a third party evidence. It has got more reliability. But again, how do you really get those evidence is again important. We'll go into that when we go into that. Inquiry is also one way of getting audit evidence. Information to be used as audit evidence. Relevance and reliability. The audit evidence should be relevant for that particular transaction, not just any audit evidence. Now, as I said, audit sampling. The objective of audit sampling, see, when you are not doing a substantial audit, when it's a big, large organization and we have to, so many transactions are there, you did not do all the transactions because if you try to do all transactions, you will miss out the major ones because you have a limited allotted time. And within that time, you have to complete your audit. Now, in that, if you are trying to do, let's say, 10,000 transactions, you will miss out some. Out of that 10,000, let's say there are 10 to 15 which are material ones and which have got possible misstatements. If by doing 10,000, you are going to miss out those 10 transactions which are material. So what you do is you cut down on those sites and you find out, okay, there's the 80-20 rule. 80% of value in terms of the transaction value will be constituted by 20% in numbers. So if you check 20 in numbers, you are going to cover 80% in the value. So that way you have covered a larger area, but you have only restricted yourself to 20 transactions. When you do 20 transactions, you are able to focus on those 20 transactions and are able to get more qualitative information, qualitative aspect rather than focusing on all the transactions and not getting any quality. So you will waste your time in that and you will not achieve any objective because the remaining 20% are non-material. Suppose even if there is a 10% error in that 20%, you still have 2% error on the entire thing. So that 2% is not material for you. But on the 80%, if you have even 5% or 10%, it is material because it will be 4 to 5% of the total numbers. So now you do a sampling. Now, how do you do sampling? It has to be a statistical based or scientific based sampling. It cannot be, oh, chalo, mere ko itna 10 vouchers lena hai, main le lunga. Aisa nahi. There should be an unbiased scientific manner of picking up sampling, which means that each of this item should be in a position to get into the sample. Then there is an unbiased way. Otherwise, the management will say, "Aap itna dekh lo." So dekh liya, chalo. That cannot be a sample because then you are missing out something which is material, and you might miss out on misstatement in that case. So you should have a totally unbiased and scientifically selected. There are various methods of selecting a sample. There are scientific methods of selecting a sample. Apply those scientific methods so that that should be again in your document. How did you selected the sample? Okay, you did this process and you selected the sample, and this is the process in which you selected a sample. If that is documented in your file, then you can always say that, see, I did the scientific. And suppose for any reason, even after applying scientific method, some document was missed out in your sample and that contains some misstatement, then you are not at fault because you did a proper scientific way, unbiased way, and that particular thing by chance, by bad luck, it has escaped that particular basis. That is not your fault. You have been diligent. You have not been negligent. But if you have just picked up some 10, 15 random samples and you say, okay, now I have done this scientific, no, that will not help you because then there is a biases involved. And it is possible that you have purposefully missed out that material misstatement wala voucher, which you knew that there was some problem and you missed out that and you did not verify that. No, that cannot happen that way. You have to ensure that it is totally unbiased. It is scientific, and when it is proved that it is scientific, it is unbiased, and your diligence and your capability is proved. ensure that every transaction has a chance of getting into it. How to use sampling techniques is you to then, once you draw a sample, then you apply those tolerable limits. Now what happens? Suppose when you draw a sample and you have verified those sample and you find that there are some errors. Now you have to first, suppose you have taken a sample size of, let's say, 20% numbers, okay, and you have found some errors in those 20. Now you apply that. Suppose you have found some errors in of 10,000 rupees or something, whatever. Apply to the entire population in that same ratio. What will be the size of total value? If it is material, then go and increase your sample size. You just don't stop it here. Okay, I have found this much only. That is fine. No, if you find a error, then you increase your sample size, increase your scope of audit, go into more details. Instead of 20%, go into 40% of the audit, depending on what is the level. And again, in 40%, you find some more extended. So you have to keep doing it till you're not satisfied that the error is in a tolerable range. Okay, so this is that's just not to accept it, and you have to project based on a sample what is the impact on the whole. And if the impact on the whole is not material, then okay, then you can accept it. But if it is material, then yes, you have to go into more details. External confirmation. Now this is very interesting. We always send external confirmation to the suppliers, customers, bankers. Now the standard lays down that it has to be direct. That means you don't give it to the management कि भाई ये supplier से आप confirmation ले लो, कि भाई ये customer से ले लो या bank से लेके आओ. No. Direct means it has to originate from the CA office. Of course, we have to take the permission of the client. Yes, we are sending external confirmation to these suppliers and to these customers and to the bankers. And we send out a confirmation directly to the suppliers and customers and the bankers directly with a request that you should confirm to us directly in our address, not to the management. And then we are able to evaluate. Once we get the confirmation from those suppliers and customers or bankers, we have to then evaluate whether it is matching with the accounts. Now, what is the methodology of giving this confirmation? Methodology is again to identify those confirmation parties. You might even take nil confirmations. You might even take confirmation of nil parties. Now we say, why would you do it for a nil parties? Because suppose if you have sent it to a supplier who has got nil balance, you may come across a situation where he might be having some purchase bills which you have not accounted, the management has not accounted. So he will say, oh, there are some few bills which is not there in this. So then you will come to know that these 5 bills were not recorded, and you have to ask the management, look, you have not recorded these 5 bills. So all this you will come to know. So even doesn't mean that nil confirmation matlab you don't have to send confirmation. So you have to take a sample which will cover most of those and operative. You know, sometimes you might even instead of balances, you might even get confirmation of transactions. Okay, what are the transactions done during the period? So that transactions also will get covered on that. Number 3, there is one very interesting thing we had observed somewhere, you know, in this thing. Okay, when you send a confirmation, generally the addresses is provided by the management. So you have to send to the supplier, addresses are given by the management, and generally we tend to accept those addresses and we start sending the confirmation. Now here something can go wrong. What can go wrong? Possibility the management may, I mean, I'm not saying that generally it happens, but it can. As I said, what can go wrong? So in that situation, something can go wrong. Some scrupulous management may give you an address of their warehouse. You have been saying nicely all the external confirmation, you are very happy that you have sent external confirmation to all the suppliers. The confirmation has not reached the supplier at all. It has reached some warehouse, which is some address of some party of the management, and they are quietly keeping quiet. And you did not receive any confirmation. So you have taken a negative confirmation saying, okay, which says that if you do not confirm within 15 days, it is deemed to be confirmed. So you assume that since he has not reported back or he has not referred back, so it is okay. But it's not reached only. So this is what has gone wrong. So what you should do in that case, now what can go wrong? How do you check? You check all the addresses with the purchase bills or something like that, so that you have at least able to say that yes, these addresses which you are sending is correct. It is reaching the confirmation. Now, what does the standard say? Suppose if you have sent a confirmation, you have not received any response. Follow up with another confirmation. Keep sending it up, maybe a 2 to 3 till the time. Okay, now you said that he is not responding. Maybe he is not interested in responding, so you accept it. But at least 2 to 3 follow-ups should be done. Now, suppose after you receive the confirmation, you might have some balances differences that you discuss with the management, reconcile those, whether it is disputed, accepted, whatever. At least you will come to know what is the situation. Now, it is quite possible that when you approach the management and look, I want to send confirmation to 5 parties or 10 parties, management may say, "Ye do party ko mat bhejo." It is possible because not because it is some fraud or there is something. They might have some issues with that party. There is some dispute going on with the party, and if you send a confirmation, then he will ask for the payment, or your dispute will get unnecessarily against the company. So now what happens? What the auditor is supposed to see? First, you evaluate what is the reason why the management doesn't why the management doesn't want to send. You ask the reason, and if you are satisfied with the reason, okay, yes, this is a genuine reason with the management feels, and if that reason will jeopardize the company's thing, so you avoid this confirmation. But that doesn't mean you stop here. You have to find alternative means to confirm these balances somehow. Maybe subsequent payments or some way in which you have to do more substantive verification of that particular account to see whether there is any material misstatement or if there is something wrong, inconsistent with what management is saying. So in that situation, your audit evidence, audit alternative approach might be applicable. If you still feel are not satisfied, then you might look at how you are going to report in your audit report. You might make a statement in the audit report relating to this particular aspect. So it all depends on your satisfaction, achieving your satisfaction based on what the management is saying and your observation on various other alternative means. And if you feel that no, it is not acceptable, what management is saying is not right, then you might think of putting in a report. Now, result of external confirmation exceptions are there. The negative confirmation, as I mentioned to you, evaluating now this is an audit evidence. So you evaluate that audit evidence and see whether there is any material misstatement or everything is okay. Analytical procedures. Analytical processes it's like a pathological test. We do our blood pressure check and all those blood tests and everything, and we come to know whether there is anything wrong or any issues are there. These analytical procedures will throw up various aspects in the financial statements, and they will give out some ratios which are inconsistent. And when you find that the ratios are inconsistent, suppose for example, there is a composition of certain material. On year after year, the company's business has remained the same, more or less the same product, same size, but the composition of the materials have changed. Suppose some material was 60% in 1 year, in some year that same material has become 40%, 30% in terms of the ratio. Then you have to see why it has happened that way. Is there a change in the product mix? Is there a change in the composition of the materials? Ask questions. You will get answers. And if you are satisfied with the answer, it's fine. But if you're not, then there is something wrong. That the material, there is a possibility of some wrong billing, wrong booking of the purchases, unbooked cost. All that is possible. So when you do this analytical review, it is not necessary that you will always get frauds. You might also get errors. And you can point out to the management, look, there is something wrong. Yes, you have missed out some bills to be provided, some expenses are not provided. The management will then rectify those errors if they find the errors are there. So this is the analytical procedures will throw up a lot of light onto the financial statements composition because they talk. This analytical procedure will make them talk. The GP ratios, the profit. There are so many ratios, so many analysis ratios. You keep verifying those processes, and then you will come to know that something is wrong. Yeah, your cash flow also. The cash flow also will speak how the funds movement has happened, what has happened to your investment transfers, how you have used the funds. All this will also give a lot of insights into the balance sheet movements, how the loans have moved, where the loans have been utilized, how the investments have been made, from where the funds have been generated, how the funds have been deployed. All this will give you an idea as to how the company is operating. And once you get an idea, you will be able to find out if there are any material misstatement or if there is anything done something to circumvent something. Okay, so that also is a part of your audit process. It will also give you a reliability of whether data is reliable. So it will also give you some confidence on the data reliability. Okay, evaluation whether the expectation is sufficiently precise, amount of difference recorded, and amount what is expected. Suppose what you are expecting GP of 15% and you are getting a GP of 8%. Suddenly you have to definitely apply mind why that there is a difference of 7%. You have to immediately analyze and see where the fluctuations have taken place. And if you are satisfied, fine. It is possible that there is some cost overrun, some sales product mix. You have to reduce some price. All that explanations have to come in from the auditor's standard. So that if it is there, then there is then that will be the basis for your audit conclusion. And you have to investigating the results of the analytical processes. Now you will see the trends, reasonableness, ratios, source of information. What is the source of your information? Is it reliable? First of all, that is important because you have to compare even industry-wise. You have to compare this industry with versus the other industry. I mean, some similar another company in a similar industry. What are their ratios? And if you find that there is inconsistency, then look at it. Why there is a specific inconsistency in this particular industry in the company? Auditing estimate uncertainty. As I mentioned to you, we have that A7. Very interesting. A7 is a highly estimate based. So if any change in the cost estimate will definitely vitiate the entire financial statement, your sales, your profit, everything is wrong, misstated. If there is a slight change in the cost estimate, so that calls for a higher level of verification. You might need a third party technical certification. Prior period. Now what happens? Okay, let's say there is a company which is making so many construction contracts, building contracts or construction contracts for so many years. You look at the past history, whether in the past whatever estimates they had made, and subsequently those projects must have been completed. What is the actual results? Suppose they estimated that the profit was 20% and their estimates have come to 18 to 22%, you accept it, tolerable range. But if you find that they always estimate 20%, but they end up with a loss, but they estimate 20%, but they've come up with something different, and the variation is huge material, then you cannot accept those estimates, because then the estimate itself is the basis of estimate itself is wrong, because past has shown that their estimation methodology is not correct. So you have to be more, you don't accept those estimates, you have to do it afresh, and you have to get a technical certification to see whether these estimates are right. Now another estimate is our warranty cost. We are supposed to, as per S29, provide warranty cost. Now, for example, we are supplying computers. There's a company which is supplying computers. At the end of we have to give 1 year's warranty. And then 1 year warranty, they have to replace either the computer or repair computer free of cost if there is any problem. Now, see, then they have provided 3% of warranty cost as during the financial year. This is again an estimate of what could be the warranty cost, because they already recognize the sale of the computers, and that cost includes the warranty cost. Now you have not provided, because the sale price includes the warranty, so you have to provide the warranty cost as per S29. Now you provide this warranty cost in the P&L account. How do you do it? 3% is what they have provided. Now whether 3% is correct, or it should be 5%, or it should be 2%, or it should be 1%. You see the past, how they have performed, whether what is the actual cost of warranty they have incurred vis-a-vis their sales. If it is within the 3% level, if it is up to 3% in the range of that, then you accept that 3% estimate as a correct basis because of the past historic basis. So you are again that documentation, very important. Your file should say how you have worked it out, how you have verified this estimate. Okay, you have worked out on this basis. It will give you support to your own judgment. Related parties, as I mentioned to you, is again a level of risk which can entail for any misstatement, because there is a familiarity, there is a possibility that there can be collusion. So you have to examine those transactions more in detail, whether there is the price, what is mentioned, the transaction level which is mentioned is at arm's length price. So you verify with the other non-related party transactions if it is available, comparable transactions, like how you do it in your transfer pricing cases. You check the arm's length price and see whether the arm's length price and this related party transactions are more or less at the same price. If it is so, then okay, you can accept the related party prices. But if it is at different level, then you should judge justification why the pricing is different than the arm's length price, and that would be the basis of your verification. Now, fraud. There is a huge number of slides for this fraud, because that is a very critical situation as of now. Again, as I said, misstatement can be two types: unintentional or intentional. Unintentional are error, and if it is intentional, it is a fraud. So these are the two types of material misstatements which can creep into the financial statements. Unintentional are innocent, because it can happen in any organization. It is possible, because errors, we are all human, so we are all likely to make errors. So the error element is always there, human element is always there. Intentional will depend on the mentality of the management. If there is a mentality of committing fraud or trying to deprive this, there is always a chance of higher fraud. The risk is higher. So when you do the entity related observation, or the management observation as to how their past performance or their ethics, you will get an idea as to whether there is a possibility of fraud. Now again, there are so many indicators which will give you an idea how fraud can be possibility. See, even a good management sometimes is motivated to do a fraud because of certain circumstances. For example, the company is possibly going for a listing, and it wants to show a picture which is required for a listing. So there is a possibility of manipulating the financial statement. There is a possibility of a fraud which is perpetrating your financial statements, and a misstatement may happen. So there is a performance pressure. Suppose they have already listed and now there's a share pressure because their pricing has to be maintained. They want to declare dividend. They want to come out with a right issue. All that will give you the pressure. These are the pressure points. Now they want to come out with some collaboration with somebody. They want to go in for a joint venture and they want to predict a particular level of financial statement. So these are the pressures. Sometimes tax can be a pressure. Okay, I am to pay such a huge tax, so there could be other way around. The financial statements are then drawn down compared to increased. In case of a listing and all that, the price has to be increased, so the financial statements are increased. The profit has increased. In some cases, profit is reduced. All that depends on what circumstances the management is operating on. There is a possibility that their performance, suppose if suppose the management incentive is based on the profit, naturally there is always a tendency to increase the profit so that their incentive, personal incentive, can be increased. So all that is depending on what is the methodology, how it is structured, and at what stage the organization is, and that factors we have to identify when you do the audit planning, assessing the risk. When you're doing assessment of risk, you have to see the entity's situation, where they are. And if this situation or these particular factors are found in that organization, then in that situation, your risk factors of this particular level of activity may be at a higher level. And so you have to mitigate the risk. So you have to work around your audit program against to cover all these things. So even though you don't start the audit with a fraud thing, but when you detect some signs, like for example, when you do a pathological test, and you find that your blood pressure is high, then you start looking at other aspects, or other things. Okay, you see your cholesterol and other things to check whether there is a heart disease or heart problem. So there is a starting point. This gives an indication. Yes, something is wrong, and when something is wrong, then you start. Like for example, now in the COVID situation, whenever you go any organization, they will check your temperature. That means if your temperature is high, that means there is something wrong. It will not be COVID, because you can have fever for other reasons also. But that at least is an indication that something is wrong. And if you don't have a fever, okay, is apparently now that you cannot identify, because even non-symptomatic is a problem. So with this, I mean, if you have the symptoms, then your risk factor is increased, and then you have to cover even for this aspect also. But the responsibility of detection of fraud is primarily into the management. Auditor responsibility is secondary. But when you come across this factor, then you can't ignore it. Then you have to look at those aspects very clearly. Now, if management driven fraud is more difficult to detect, because it must have been done very skillfully. As I told you, in one case, when we had to verify this cost of construction of road, we found all the bills, everything was perfect, because it was all very well managed. And it was very well systematically done, so that the auditors ko malum nahi padega. Lekin we worked around it, and we said, kuch to gadbad hai. And then when we did that other verification, it came up. So, but only doing the vouching and only those purchase bills would not have detected that particular fraud. I'll give you a very interesting example. During one of our audits in outstation audits, one of my junior had done the audit, and they brought one very small query, very simple query. We always go for, whenever we do audit, we do a cash verification. And when he did cash verification, he found that cash was in order. Whatever was there reported in the petty cash, it was found in the order. But while doing the petty cash or cash vouching, we found that one purchase voucher was accounted twice, identical amount, accounted twice by error. Okay. Now he raised a very simple, very mundane query, sir, purchase ka expense ka voucher 2 baar account hua hai. So I said, I mean, it's not a mundane query. First, and tell me, how did his cash tally? If there was an error, suppose if one voucher is accounted twice, that means there is an error in the cash balance. It should have been detected immediately. Not by auditor, by the management himself, by the cashier himself. He should have himself found out that there is the error, because he would have found more cash than what is there in the books, because he has accounted a voucher twice. Why he did not detect? Because his cash match actually identical. That means I said there is some fraud. Then we went into the detail, that started with a small item of some 25,000 rupees, but it came to around almost about 10 lakh rupees of fraud. We found so many other items and so many, because then we started into full-fledged investigation. And when we went into that, we found that there were many such transactions like that. And ultimately, we found some 10 lakh rupees of fraud which was detected. And we reported to the management, and the person was sacked, and he recovered this 10 lakh. So this is what happens. Sometimes a very small query, which will not actually, will get missed out. Okay, do voucher double account kiya, chalo usko rectify kar do, aur kya. But that was not the end of the story. You have to start looking at something else. It had other repercussions. How did this balance tally? This balance should not have tallied. It should have said a difference. Oh, there is a difference of 25,000 hair difference. Okay, petty cash per difference aa raha hai. He should have said that. Then it was okay. Then it was not a fraud. But if he has tallied the cash, that means he was aware that there is a difference and he has adjusted. So this is how things come out. So your again, analytical mind, your chartered accountant's training, how you are trained. This is not there in the books, but you have to apply your mind get trained into this, and the analytical mind which is there, which you are trained for, is what will give you this kind of answers. Professional skepticism. Do not get carried away by the past honesty. Okay, everything is fine. Management is very honest, but at that juncture, possibility he might have some compulsions, and he might have to do something wrong. So we don't know. Don't just go carried away by the past management. Generally, when a documents are given by the management, we take it on the face value. We don't question them. We don't go into a forensic audit whether it is fraudulent document or it is signed wrongly. We don't do that unless there is a evidence to the contrary. No, this particular thing appears to be a fraudulent signature. Then only we look into that forensic part of it. Inconsistency in the response by them. As I told you, you asked 10 questions. First question answered in a different manner. The similar questions under number 8 answered in a different manner. There are inconsistency in the management response. This is how we can find out that there is something wrong. This is the audit text, the appropriators of journal entries at the end, particularly those passed at the end. I will quickly go into the more slides because there in the fraud there is a huge number of slides which we can share with the thing. So review of the accounting estimate. As I said, accounting estimates will have a very important bearing on the frauds. Retrospective review of past estimates and judgment. What we made in the past. Check for bias in the judgment. Could there be a bias in the judgment, or is it unbiased? Or is it technical? Significant unusual transactions. If there are any unusual transactions happening in the organization, which is not regularly done, look into those specifically. Not part of the audit sampling. Check those specifically, irrespective of the sampling. So in those transactions, we may throw out some irregularity, some misstatements. Audit evidence, you do analytical review. Possible fallout. Suppose if you find that no, this is too much of a fraud, possibly you might have to withdraw from the audit engagement. I will not do the audit engagement with this kind of a huge amount of fraud. We are not interested in doing it. Management representations. You might take a management representation on the fraud. Communicating. You have to communicate with those charged with auditors. See, we have found this, and that is again under the Companies Act. We have a duty as a statutory auditor that if you find a fraud of a particular limit, you might internally communicate with the audit committee and report to the audit committee in writing that this we have detected some fraud. If in case if it is beyond the limit, then you have to report to the central government directly, to the ROC. But there again, there are some guidance note in that. I'm not getting into that. Institute has come out with a guidance note that is how do you report to the CG? Because you just can't report to anything to the CG just by your fancies that there is some fraud, because it has got repercussions on the company. Communication with regular authority. That is what I'm saying. If you are informing the central government, you have to be very careful. Before you make a statement, you have to be thoroughly conversant on what you are documenting. In your documentation for fraud has to be perfect, because as I said, documentation for everything has to be perfect, but particularly for fraud, because that is very important, because tomorrow there can be claims. Why did you not report to central government, or why did you report? Both can be a problem. Suppose for example, I'll give you an example. There is some duty to report to central government. Suppose while doing the audit, you have come across some situations where there is a possibility of a fraud. Fraud does not actually happen, but there is a chance of fraud. And the responsibility is that there is a possibility, then you are supposed to report. You go and report to central government. Because central government reporting, it becomes public. There is a listed company, the share price will crash. After some time, after investigation, the central government will start investigating. After a few years or 1 year, you find that no, there was no fraud. It was our own mistake. The company will definitely file a claim against you because you have messed up the entire company's financials. But now that is the reason institute has come out with a guidance on what basis or what is the circumstance under which you will report. You have to be very clear about it. You cannot just have a hunch. You have to have the evidence to say that yes, there is a fraud. Otherwise, you don't report. So that these are the rules and regulations you have to follow. Documentation again is very important. So that you have to document how did you determine that there is a fraud. And if you have not documented it and done this, you are in for trouble. For both, either the central government or from the management, both will create problems. The incentive, as I mentioned to you, what are the incentive for fraud? If there is any somebody is living beyond its means, so he is got incentive to make some money out of it. So that is again one thing. You have to find out whether the people who are in charge of certain operations have got enough resources, are well placed. If they are not, if they are just beyond their means, then there's a possibility of making some money out here. There is a tax saving is possible. That is for that reason they are doing some fraudulent transactions, rationalize fraudulent activities, inflate earnings to secure bank borrowings, because then there is a major issue, because tomorrow the bank will come after the auditors. They have relied on the auditor statements. So when there is a default in the bank, next thing they will do is auditors problem. It has happened in many cases. So some recording fixtures, entries, how it is done. Inappropriate adjusting assumption and changing judgments. You keep changing the judgments, omitting or advancing or delaying recognition of transactions that have occurred. You are supposed to recognize certain expenses you have not recognized. Concealing, not disclosing the facts. Engaging in complex transactions like a subsidiary, huge channels, and trying to do transaction to them. Altering records and terms related to which are different kinds how the fraud is perpetrated. In case of fraud by employees, embezzling receipts, they take the money out and they don't deposit in the bank. Stealing physical assets, or because you don't know, it is not listed out, assets have gone out. Intellectual property, the company's IP is used by the employees for their own benefits. Causing entity to pay for goods and services not received. Using entities' assets for personal use. All this is generally done by employees. Management will not resort to all this. Now you talk to the various people and make inquiries to find out whether there is any such situation, in-house legal, and then you take appropriate action. Pressure from third parties, profitability levels we want to maintain. There are some, those merchant bankers or some people who have been advising. So all those things will definitely make some impact on the company's profitability. Poor financial results on financial pending transactions such as business combination or contract awards. So even these merchant bankers, they keep on monitoring the company's accounts, and because they are also part of that listing thing, and they ensure that there is no fraud, because they also look at the company's financials in a very microscopic way, and that also is a negative, deterrent for the management, that they will not commit fraud, because there are so many people who are looking at the financials. There are analysts and there are SEBI, and there are people who are looking at the financial statements and in a very thoroughly microscopic way. So that is a deterrent for the management not to commit such fraud. And these are the people who always are like watchdogs. Financial position is threatened due to significant financial interest in the company. Suppose if the management has an interest in the financial interest in the company, so they want to increase their own net worth, share value. Their bonuses are linked to the profits. So then naturally there is a possibility of increasing the profits to get more bonuses for themselves. Personal guarantee or debt for the entity if they have given. So they want to maintain that. So they've done something. So excessive pressure on management to operate to meet targets. That also is one of the reasons. Like for example, some companies will dump sales just to achieve some target, but they are not actual sales. It's just a book entry. There are red flags. So related party transaction, not in ordinary course of business. Highly complex transaction with structure I mentioned to you. Business intermediaries which are there. Significant bank accounts and subsidiary branch operations. So these are all various audit aspects which gives you some indication of fraud. So I'll skip those. There are so many such slides on those frauds which can be discussed later. Going concern. Now, going concern is, as I told you, is a very important element in a financial statement. It is a fundamental principle that on which the entire accounts are made. Now, what is a going concern? The financial statements are prepared on a historical cost basis because it is assumed that the company is going to run for a long period of time, and whatever liabilities are there, that will be met by selling off, by liquidating their current assets, and like debtors will take care of the current liabilities, and they don't have to really sell off their entire undertaking to pay off the debts, or they are not in the crisis where they will not be in a position to pay their debts in a normal business environment. So this is an important criteria for a going concern. If there is a situation, what are the situation which concerns going concern? What are the indicators that now this concern may not be a going concern? Negative current ratio, means their current liability is much higher than their current asset. That means one of their creditors are so high, but their debtors are less. How will they meet? Even if they recover the debtors, how are they stock? How will they meet the current liabilities? So there is no money in the company, no current. They can't liquidate their fixed assets and pay the current liability. That is not the objective. But how are they going to do this? In fixed term, you've got a fixed term borrowing maturity without prospect of renewal. They have got so many loans which are getting matured. There is a 1 year, within 1 year they are getting liquidated, and they don't have the money to pay those liabilities, and there is no chance of getting those things renewed. So in that situation, also there is a liquidity crisis. Short-term borrowings for long-term. If you see the CARO, now it is being introduced, whether the short-term funds have been used for long-term purpose. Now, if that is done, that is a wrong financial management. That is a like suicide pact. If you use to money which you have to pay in 6 months for an asset which is going to yield results in 2 years, 3 years, you are in for a big trouble. You should always have long-term funds for long-term usage. That is a normal financial management, good financial management. But if they do a wrong financial management, they will end up into problem. Withdrawal also financial support by creditors. Creditors say, no, I will not give you credit. You want my money back. Even your banks have withdrawn the credit facilities and say, no, I want the money back. All this will give you an indication that a going concern is a question mark. It is not necessary that one factor is there and then there is not a going concern. There should be a multiple factors, and which may indicate now the concern has a problem and they will not be able to sustain in the near future, and they might go bankrupt. In that situation, you have to look at going concern issue. Then what you do is, because there are so many things to discuss with the management. Management has to make an assessment whether they are going concern. Now, it is the first thing is the management has to make an assessment. Management has made an assessment and they found that, look, yes, we are in a position to be able to come out of this. There's a minor issues, and these are the plans of which how we are going to do it. And if you are satisfied with those plans, then yes, you can look at maintaining the going concern concept and accept the management's content. But if you are not, then either you qualify, because it's an adverse comment and it is a very serious comment because it is impacting the entire financial statement of the accounts. It is not true and fair at all. So you cannot give this opinion, and you will give an adverse opinion. And if the management has, then okay, if they said okay, I will make the accounts as per not going concern on a liquidation basis, then you don't need to qualify, but just make a reporting and an emphasis of a statement. Yes, this is how the management is evaluated and prepared the financial statement on a non-going concern basis. So that there is no question of qualifying it or giving an adverse view, because the financial statements are prepared on a liquidation basis. All the assets and liabilities are on the realizable value. That means all the assets have been drawn down to a realizable value, not on the cost basis. So that is how the not a going concern financial statements are prepared. So, I mean, there are some case scenarios. I will not get into it because of the constraints of time, because we have still got a lot of important things to discuss. Losing the work of an internal auditor. As I mentioned to you, there will be a sharing of work between external auditor and internal auditor. You have to do a very thorough scope definition, okay, what he will do and what you will do. And you will also have to ensure that what you are relying the work on the internal auditor, his level, his scope, his independence, all that has to be examined. He has to give an undertaking. Yes, he is independent, he is unbiased, he will work as per the standard of audits, and codes of ethics, everything can be followed. All that capabilities you have to check whether he has got a capability of, to that extent, what level of work he is expected to do. You have to see that whether he has a capability and then rely on this work. Just cannot take a blind reliance on work. Okay. So documentation again is very important, using the work of that. Now, using a work of an auditor's expert. Now here you have to, when we are relying on a certificate of other expert, you have to be very careful, because you have to read what certificate is given. I'll give you a very interesting example. One army was recruiting some people, and I mean not army, really some organization was recruiting some persons, and they said, okay, look, you require a health certificate that you are fit to work in this organization. So he went to a doctor and he told the doctor that, look, give me a certificate that I am fit to work. The doctor examined him and the doctor said, no, you are not fit to work. You have got so many issues. So then he said, okay, you write in the certificate that I am not fit to work. I have got so many issues. The doctor prepared a certificate saying that he is not fit to work. He took the certificate to that organization, and that organization say, okay, certificate is required, certificate is there, okay, kept in the file, matter over. It's not the way it works. When a certificate from an expert is taken, you have to read what is mentioned in that, whether it complies with what is required of that thing. Like for example, in a gratuity, when you always get a gratuity certificate from an actuary, you just keep it blindly in the file. We require gratuity certificate, it is there. But have you read gratuity certificate? In that there are many clauses which says, I am not going to accept this, I'm not going to do this. And it says, it very clearly says, it is based on what data was provided by the management. Now, suppose tomorrow, if there are 100 employees in the organization, if they give data of only 50 employees, they will give certificate for 50 employees. So 50 employees, a gratuity provision is not made. Whether have you seen what data was given to that actuary? Because actuary doesn't know. Actuary doesn't have not come and seen the company's audit. Company has gone and seen whether all 100 employees are there. 100, how many employees? He's not gone and seen. He's sitting in his office. The employer has sent, the company has sent him 150 employees list with all the salary, working, everything. Based on sitting in his office, he's got a program. He will work out the gratuity working. He will of course take all the MRL from the management that yes, it is all 50 employees only, and he will, based on that, he will work out the certificate and give it. Now, that is based on what data management has. It is mentioned in that certificate that it is based on what management has given me. I am not concerned. I have not gone and checked whether it is 100 employees or 200 employees. Now, it is the auditor who should see whether the 100 employees ka data gaya hai or 50 employees ka data gaya. Because you are an auditor, you know that there are 100 people whose salary is being paid. Now, if the 50 ka data gaya, then your data is wrong. The basis of certificate itself is wrong. So you cannot rely on it. So now this is all very important, which you have to look at as an auditor, because you cannot just blindly rely. You have to see the underlying facts, underlying data. And of course, if you see the actual evaluation, all these disclaimers are there that I have relied on what management has given. He has not gone and verified how many employees are there. He has relied on a management representation. Okay, yes, there are 100 employees or 50 employees or whatever. Whether actually it is there or not, that we are supposed to check. Now, forming an opinion. After doing all this work, you come to the main thing. You have to start forming an opinion. Whether these statements are free from misstatements, whether you can say it is an unmodified opinion or you have to give a modified opinion. This is very critical because all your work, entire work of your audit is now culminating into the report. Now, when you go into the report, you have to see, you have to start preparing your report. Now, there has been a full modification of the entire report from 1st of April 18 financial statement onwards. So if you're from any financial statement after accounting years after 1st of April 18, that is ending on March 19 or so, you have to, there's a new format which has been prescribed, which is on the international lines. It is not, earlier we had our own formats. Now the international, globally things have changed. So there has been a modification to that report on the international global side. Now, what is contained in the audit report is totally different, and there is a reason why. I will explain to you why. Now, there is, as I mentioned to you, it is revised based on the international standards. Now, how an auditor forms an opinion, sufficient evidence is obtained, uncorrected misstatements, now what he will do is he gets one financial statement from the management, he will do all this process, he will discuss with the management, he will try to correct all those errors, discussing with the management, whatever corrections are done, it's fine, that is not to be reported. But what is not corrected then requires reporting, because that is gone into the financial statement, management has not accepted this contention, and then he has got only chances this audit report where he can report. Now, how to report is what we have to discuss. Okay, so he has to see the terminology, whether it is appropriate, whether adequate disclosures are made, whether estimates are reasonable, all the applicable financial framework is properly applied for, evaluations of management judgment that he will have to see, overall presentation of the financial statement, financial presence, underlying transaction, and even it is a fair presentation, true and fair. That is very important. We are verifying true and fair of the reporting on true and not certifying true and fair of the financial statements. So now the revised format has changed. Earlier, we used to start with management responsibility, auditors responsibilities, so, and then ultimately last we used to say opinion. The entire format has been ulta-sulta, reverse. Okay. Now the first is the title. The title starts with independent that this is an independent auditor's report. As I mentioned to you initially, independent. What is independent? Now, auditor is supposed to be independent because he is not an employee of the company. But can you say it is an independent? No. There are some criteria. What are the criteria? Suppose I'll give you an example. Suppose there is an audit firm who has got, let's say, 100 clients. Out of 100 clients, he's got fees, let's say, of 2 crore rupees. His total fees of the client of that audit firm is 2 crore rupees. Out of which almost 1 crore rupees is coming from one group of clients. And the remaining 1 crore is coming from the 99 different clients, small, income tax returns, chota fees aata hai. But a major bulk chunk fees, almost 1 crore is coming from one group of clients. Whether he is independent in relation to that group, no. Why? Because tomorrow, if you have any audit issue with the client, and suppose tomorrow you raise some red flags and say, these are the qualifications I want to give, the client will say, I will change you. Either you accept, you don't give this qualification, or I will change you. Now, whether at that juncture, whether you can say, no, I will not remove those qualifications, I will continue my qualifications. That is a test for independence. Now, when you are 50% having revenue from that one client, you are going to start thinking, how will I survive? How will I meet my overheads? I've got rentals, I've got salary payments, I've got my own practice. How will I manage? So there is a pressure on the auditor to be non-independent, because then he is become biased, because he gets carried away. You should not get carried away. That is the first fundamental principle of a chartered accountant, being independent. Now, to be independent, you should have a broad basing of your fees. That is what the standard, even the code of ethics tells you, that you should have your broad-based fees. You should not have 40% of fees coming from one group of client. Okay, there are criteria given. Now that 40% has been reduced to 15%, because you should not have a bulk of fees coming from one client, because then possibility is there that he may dictate terms. So in that situation, when the fees are broad-based and you are not dependent really on one client for your survival, then you can say, no, I will not sign. I will not do this. You are in a position to be more independent and more upright, and say, no, I will not do it, because I am not having that fear in my mind that how will I survive. The survival is not an issue, because that 10-15% you can always go up and increase somewhere else, and you can survive without that. It is not a material and critical for you to survive. That is the test for independence. There are other tests also for independence, your own frame of mind and all that. So now what they have done is they have put in auditor's opinion. Auditor's opinion is the first item in the paragraph. Okay, I will go through each and every aspect here. Then there is a basis for opinion. Why auditor's opinion has been brought in first? The earlier auditor's opinion was somewhere in the end. Again, I said why? Why? Right? Why? Because see, when you get a newspaper in the morning, you see headlines, right? Yeah. Why? You don't have a time to read all the small things. So this auditor's opinion, which is coming first, will give you a highlight. Adverse report, adverse opinion, qualified opinion. It will give you straight, hey, this is something wrong. But earlier, what was happening? You read all the management responsibility. Then by the time you have lost interest in the audit report, the last auditors mein aata hai adverse hai. You lose by the time you have not read. You just rush to the paper. So your interest has to be kept alive, like how you do it in the headlines in the newspaper. So it has to be immediately hit you. Okay, look, there is this particular report is adverse. This particular report is qualified. All that will come out only when it is a highlight. So that auditor's opinion will give you that initial strike. Basis for opinion. Then you say, what is the basis for this opinion? There you are going to say that why you are giving this adverse opinion or qualified opinion. Then you mention that because of this point, I am giving this qualified opinion, or I am giving adverse opinion, or whatever. And based on that, you make the opinion. Going concern, again, you are supposed to say whether the management assessment is okay. Key audit managers. What now? This is something different. This is something new. Key audit matters is applicable only to listed companies. Suppose in your audit, while doing the audit, you have come across some areas of issues which you have discussed with the management and resolved. So that doesn't go in your audit report, because you have resolved those aspects. You've identified some issues. You've identified some audit matters which you have discussed with the client, major one, not the small queries, mid queries, like your AS7, how did you do the estimation? All that you have done, and now you have come out with some solution, and you are satisfied with the solution, and now you have not reported because you find that you are satisfied. But then you are supposed to report in this KM. You had identified these audit matters and how did you resolve it? So that the shareholders who are reading the report should know what are the things you had identified as a KM and how did you resolve it. Although it is not gone into your as a qualification or report, but this will be giving indication that you had identified certain to the major ones, not the small items, the material major items which you have identified during audit, you will have to report. And this is only in respect of listed companies, not in respect of this. Emphasis of matter is where you want to just draw attention to certain important notes in the financial statements, not as a qualification, but just to show to draw attention to the, because there are so many notes, all these notes can get missed out. So specifically you draw attention to the ये note जरा पढ़ो, इसमें कुछ लिखा है, but nothing to do qualification, but something important which is based, which is important for reading the financial statement. So that you bring out emphasis of matter. Other information is where in the financial statement there are so many and suppose when you see the annual report of the company, there are so many such other information given, like some ratios and all that, which is not audited, which is not part of the audit report, but it is given as along with a booklet. So people who are reading that book might think that it is audited. So there could be inconsistency between your audit financial statement and those management representation, management information. You have to read, you not to audit. Read those things, and if you find any inconsistency, mention that, or you ask the management to correct it. If they don't correct, mention in this particular aspect. Responsibilities for the financial management. Who is the responsible for financial management? Management. Very simple. Auditor is not responsible for financial management, is only responsible for conducting the audit, not the other reporting responsibilities like CARO and all that. Signature of the auditor. Signature should be only after the management has signed the financial statement, not before that. Then place of signature, where you have signed, and date is very important. Now, of course, the UDN also is very important. When you have signed, because the date will show a cutoff. After that, you don't know. Before that, whatever has happened, you are aware. Now, as I already mentioned to you, what is independence? I'm not going into it. I've already explained you the independence, how to work out independence. Give me 2 minutes. I'll finish in 2 minutes. Now, Code of ethics, again, I've explained you what it is. Now, what type of reports are there? There are only three types of report. Of course, first is unmodified. You have found that financial statements are free from material statements. You are not making any adverse qualification on that. Second is if you find that there are some aspect which is not free, but there are material misstatements. Now you have to qualify. Now, what kind of qualification? There are three types of qualification. One is a qualified audit report. Second is the adverse report or disclaimer report. When you have to use this, I will just quickly take you. When you find that there are certain material misstatement is there, but it is not pervasive. It is not all over the place. It is not all over the financial statement, or it is not impacting a major one aspect of your P&L account, but it is there, small items somewhere spread over, but material spread over. I mean, some items are there which is material misstatement. You will give a qualified opinion saying that these are the aspects subject to that. I mean, we will accept that everything is okay. Now, if you find that it is all over the place and it is something which is, like a major thing and just not some few items, then you give adverse opinion, because then you don't say it is true and fair subject, I mean, except for that. So you have to then say it is not true and fair. Now, I'll give you a very simple example. Somebody goes to a doctor and says, doctor, please give me, I am healthy. The doctor will verify him, examine him, and say he has got cancer, he has got high blood pressure, he has got all kinds of major ailments. And then can doctor say, subject to all that, it is healthy? No, because he is not healthy, then he is not healthy. If he got some minor ailments, then he can say, okay, subject to some few aspects, he is healthy. So here again, if there are major qualifications, then you can't say subject to that, my accounts are true and fair. No, you have to say it is not true and fair. That is adverse opinion. That is a negative opinion. Disclaimer of opinion means what? Suppose there are no records to be verified. There are no books. Books are already destroyed. Some income tax raid has taken. All the books are not there. You're not verified. So you don't know whether the books are true and fair. It could be true. It could not be true. So you have to give a disclaimer. I cannot verify. I'm not verified the evidence. How can I say it is true and fair? Or how can I say it is not true and fair also? So you give a disclaimer of opinion. So this is the major methodology in which you will report. Last but not least, follow the standards of audit. Documentation, what is not documentation is not done. Be alert, check and read any material on which reliance is placed. You document whatever is there. Maintain independence, compliance with accounting accounting standard or else face ICI, NFRA disciplinary action, class action suits, serious fraud offense. Thank you very much. I hope I have been able to communicate what I need to communicate in these 2 hours for auditing. If there are any questions, I don't know whether we have time for the questions or let now the ICI take over. Yeah, over to you.
Sir, wait for 2 minutes, sir. Hello.
Very good.
सर झालंय त्यांचं सेशन, तर तुम्ही वोट ऑफ थँक्स देता ना?
नाही देतो मी.
हो.
पण ती लाईव्ह असेल तर मला माहित नाही. Sir, really, I appreciate on behalf of Pune branch of WIRC of ICAI, you have given tremendous detailed knowledge to the students. Student will be more happy. On behalf of institute, on behalf of branch, I thanks to you, your team, as well as your knowledge. Salute to you. Thank you. Namaste, sir.
Thank you very much.
Now we are not live, no, now.
लाईव्ह आहोत अजून. एंड करू का?
Yes.
थँक्यू.
Thank you.
Thank you very much.
सर गोवा वाला क्या नाम है?
Kusai Goa wala, yes.
हाँ, कुसई गोवा वाला, वो मुझे गलत लग रहा था. मुझे मंदिर में कुसई